The global economy, we are seeing negative news coming from everywhere at the service, right? So we see two wars happening, one in Europe and one in the Middle East, and that war is not slowing down. So everybody's trying to escalate that war further. So funding is being thrown at it, more weapons are being provided. So nobody's trying to find a peaceful resolution. In fact, everybody is trying to escalate the war. So those two wars still going on for the last 2 years, and it may continue as it looks like. So we're seeing wars happening. We're seeing global economy is shrinking. We're seeing recession being declared in Germany, UK. We are seeing Japan is slowing down. Their currency is crashing hard against US dollar. We're seeing Chinese economy slowing down big time. Their real estate is crashing as well, which will have spillover impact across other markets. I have made another video about this on my channel, so take a look at that. And when we see all of this happening, right, we are seeing economy slowing down in Canada here as well. And when we look at US markets, the stock market is all-time high. Not only the US stock market, but also Canadian TSX index. We look at the DAX index in Germany, FTSE in UK as well. So the stock market is all-time high and it's keep ripping higher. No matter what negative news comes out, the market is still ripping higher. And I see two reasons behind this. Number one, there is an AI boom happening, and there's a lot of speculation also happening in that industry, where if the company has AI written next to it, the investors are piling money into it without even thinking about it, whether this is going to be a profitable business or not. One example is, look it up, C3.ai is a company. Its stock ticker is AI actually, and mediocre company, but surviving since 2009 and a lot of money being poured into it. So this reminds me of .com bubble, when every company was attracting a lot of capital because they had .net or .com written next to it. So that's euphoria is kind of driving the markets ahead. And the second reason is the perception in the market, where the bad news is considered a good news. For example, all the negative data we are seeing in terms of jobless claims, shrinking household savings accounts, the earnings reports, in terms of the projection for the future, that is also declining. We're seeing a lot of layoffs happening across the IT sector, and a lot of trucking businesses going out of business. So a lot of negative news is coming out of the economy, but that negative news is considered a good news, because the market is expecting that at some point the Federal Reserve will start cutting rates. And once it happens, they perceive this as a good news, because then they think, they means the retail investors or the market participants, they will see the market will rally after that. But that's a theoretical assumption, right? We have seen in the past, the moment Federal Reserve cuts rate, that is because they are seeing something blowing up in the economy, and they're actually cutting rates in order to rescue that. And while doing that, the market actually crashes. Even in March 2020, when they cut rates, the market tanked. The market only went up again when the US government starts spending bill, the CARES Act. When they announced that, then the market started ripping higher. But during the time when the rates are being cut by the Federal Reserve, the market was tanking. So that scenario, in terms of the bad news is considered good news, this is one of the reasons why the markets are still ripping higher. And this is not sustainable, as you know, right? At some point, that bad news will be considered bad news. And this requires a catalyst, to be honest. What that catalyst would be, I don't know. But when I watched the presidential debate last week, it makes me think that debate is going to be, or likely to be, a catalyst, because we saw what happened between Trump and Biden. Biden is no doubt is being called out by the media as well, that he's not fit for the race, so he should be stepping down and let anybody else to replace him. But during this political turmoil, I think this could trigger an event that could perhaps make markets realize that bad news is actually bad news. The article that I was reading was that talks about how the companies with the weak balance sheets are losing capital. So this chart actually shows you the percentage difference between the capital inflow into the companies with the weaker balance sheet versus the stronger balance sheet. So it's basically showing you, a dip into those companies which has weaker balance sheet. So all of these companies where they have a lot of debt and their debt servicing cost is going higher compared to their earnings, those companies are going to face tough conditions going forward. And the moment the market realize the bad news is still the bad news, this is when things will get ugly and there will likely be a major correction in the market. I don't know when this will happen. It may continue for another 6 months, 12 months, who knows. But I think, as you know, this is not sustainable. You cannot perceive bad news as good news forever. At some point, this has to be looked at from a reality perspective. And I think the moment Federal Reserve start cutting rates, this could be the moment when the market will realize now we see bad news as bad news and things can get ugly from that point onwards. Anyway, you let me know what you think about it and tell me exactly how are you protecting your assets, your financial future, and what is your investment strategy. If you need any help with regards to financial planning, your kids' education planning, and your retirement planning, estate planning, let me know. I have partnership with Aegon Research. I can connect you one of my best financial advisor, and they can help you with regards to your financial planning. If you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.